Hi everybody, this is Thomas Wynn with the third quarter market summary. On your screen is all my contact info. If you have any questions or comments, please reach out anytime. Before we get into the summary, let's take a look at where we are in the stock market. This chart of the S&P 500 US large cap stocks shows that this dotted line is the beginning of the year, and the all-time high was made on the 4th, and we've been declining ever since. So a couple of steep declines and a bunch of rallies. The end of the quarter for the third quarter was right at this point, down 24.75%. The low point of the year so far has been 26.6% decline. Again, these are US large cap stocks, and that was the day the Fed raised rates 75 basis points, and the market gapped down severely but then rallied about 6%. So we've been rallying since that date, even though the Fed is going to raise rates further. And actually, let's take a look at what the Fed funds rate is doing. This is a very far look all the way back to 2003 of the Fed funds rate. If we start in the near term, we know that rates have increased very, very quickly this year to fight inflation and to try to reduce speculation in all markets. The Fed was raising rates back in the period from 16 to 19, but then the pandemic hit and they reversed and reduced rates very quickly back down to zero again. The target rate that the Fed has as of this moment is 4.25% to 4.5%, and that is, there are futures that track what the Fed is saying, and this is a moving target, but this is where it is at the moment. It's certainly not written in stone. Anything could happen that would make it either rise or fall. This displays a period of after the real estate bubble burst. Rates were zero for almost 8 years, and that led to a lot of speculation in a lot of different areas of the market. You could borrow at zero and speculate on things. This was the decline of interest rates during the big recession of 07-08, and this was the rise in interest rates trying to get people to stop speculating, which didn't work very well. So let's go back to the market summary and take a look at asset classes for the quarter, and everything down for the third quarter, and average returns are on this line. The best quarter show very good returns some years and or quarters, and the worst quarter for bonds in particular, it actually had the worst quarter ever in the first quarter this year, and bonds were down again this quarter. Not as much, but pretty close. If we look out further, and all of us should be trying to have long-term horizons on our investments, the one-year returns are all negative. The 5-year returns have positives in 3 categories, including U.S. annualized 5-year returns of 8.62. And then over the longer term, the reason why we invest is that we've consistently made money by holding on to different types of investment assets over long periods of time. Here is the news in the relatively short term, just for the quarter. It is the price on the graph and the news that accompanied the price. This is basically the same. The next chart is the same thing, just over longer periods. The inset is a very long period from 2000 to the present, and this is about a 1-year chart in the recent news. Now we're going to look at each type of stock, U.S., international, and developed countries. And in the U.S., large value, which had been doing very, very well earlier, now was the worst performing of all the categories, and the longer term annualized returns are down below. Developed countries like Europe and other developed countries also had negative returns. Value was the worst performing, and growth was a little bit better. And emerging markets performed the worst of all, and actually opposite, growth did worse and value did a little bit better. The country chart is usually pretty volatile, and again, this year there were a very minority of countries had positive returns. The U.S. was not as bad as the rest of the world by country. Globally, this was the return. A lot of countries had very, very negative returns during the period. Real estate has been acting poorly for the quarter, year to date, 1 year, and even 3-year annualized returns are negative. For global, even the 5-year annualized returns are negative, but positive at 2% a year for US. The real estate fund that we use was chosen to be a diversifier and not act like the rest of real estate. It's not hard assets, it's a loan fund that's been historically very resilient during market volatility. And it is doing, these are the returns for the clients that hold that fund. Commodities also very, very volatile. In the quarter down, year to date positive though, and 1 year and 3-year annualized, even 5 years. But over the long term, commodities had such a period of deflation for so long that the 10-year returns are still negative. But for shorter periods, positive. For the quarter, not so much. In the energy sector, gas was up significantly, but all the other energy components were down pretty severely. So future will tell, and events will tell us how that goes. Fixed income has an interesting component, and this is what is called the inverted yield curve. And that is when short-term rates like CDs and many other short-term interest rates are higher than long-term. It implies that investors believe that high inflation and high interest rates won't endure, or else interest rates for the long term would rise. But they have risen very sharply. It is hard to borrow in the short term, and the Fed is trying to make it hard to borrow. So people will take money out of stocks and put them in bonds, or otherwise put them into savings rather than speculating on all the various assets that have been speculated on recently. So this is DFA's editorial, and it basically is talking about ingenuity and technology advances are what drive prices and stock market returns. It is several pages long, and then here's all my contact information again. And that's it. I hope you find all of this helpful, and please contact me anytime if you have any questions or comments. Thanks a lot. Bye-bye.